Welcome back to Lutamarkets. Today, we're diving into the mechanics of the daily range and the fascinating concept of market protraction, often referred to as the Juda Swing. These are critical tools for traders who want to decode the market's rhythm and time their entries with precision. By the end of this video, you'll understand how the interbank price delivery algorithm influences the daily range, how manipulation plays a role in price movement, and why specific times of the day matter so much. Plus, we'll walk through live examples to bring these concepts to life, so stick around till the end. Let's start with the daily range. Did you know that every trading day follows a predictable rhythm? Let's break down the daily range and how each session plays a role in shaping the market's rhythm. The day starts quietly with the Asian session. This is a period of consolidation, where the market moves slowly, building up orders both above and below the range. Think of this as the calm before the storm. It sets the foundation for the big moves that follow. Next, we move into the London session, also known as the London kill zone, which runs from 2 a.m. to 5 a.m. New York time. This is when the market begins to come alive. During this time, we often see manipulation, or what's called the Juda Swing. This is a sharp, false move that grabs liquidity, traps retail traders, and sets either the low of the day or the high of the day. It's like the market playing a trick to set up the true direction for the day. Then comes the New York session, where things really start to take shape. From 8 a.m. to 11 a.m. New York time, the New York open kill zone gives us clear opportunities. During this window, the price often retraces into an optimal trade entry before expanding further in the direction established during London. Alternatively, if the price has reached a significant target, it may reverse and head the other way. By late morning, between 11 a.m. and 1 p.m., we typically see the market reach the opposite side of the range, completing the rhythm of the day. Finally, after 3 p.m. New York time, the market slows down and enters another period of consolidation, often referred to as the dead time. This quiet phase marks the end of the day's cycle, and we wait for the next session to start it all over again. When you understand this flow, from Asian consolidation to London manipulation to New York's retracement or continuation, you'll start to see the market's rhythm more clearly and time your trades with precision. Key patterns in the daily range. Trading the daily range isn't just about watching charts, it's about understanding the natural rhythm of the market. Each day unfolds in a sequence of predictable patterns, and once you grasp this flow, you'll gain a significant edge in your trading. Let's break it down. Consolidation leads to manipulation. The day begins quietly, typically during the Asian session, with consolidation. This is the phase where the market is building orders. Think of it as a calm before the storm, where both retail and institutional players are positioning for the next big move. Then comes the manipulation, often referred to as protraction or the Juda Swing. This is when the market makes a sharp, false move to grab liquidity, trapping retail traders and enticing them to enter positions in the wrong direction. It's a classic bait and switch that sets the stage for the true move of the day. Retracement into an optimal trade entry. After the manipulation, the market begins to reveal its hand. The price retraces into an optimal trade entry zone, providing a high probability point for you to enter in the direction of the true trend. This is your chance to align with the institutional order flow, riding the wave as the market begins its expansion. Expansion takes control. This is the phase where the market breaks free. Price moves decisively, often reaching for higher time frame targets or liquidity pools. Expansion is where the bulk of the day's momentum is found, and it's the phase that often defines a trader's success or failure. Reversal and consolidation. As the day progresses, particularly around the London close, 12 p.m. to 2 p.m. New York time, the market may reverse from its expansion, retracing part of the move. This reversal is typically a reaction to significant price levels or exhaustion after reaching targets. Finally, as the trading day nears its end, the market returns to consolidation during the dead time, typically after 3 p.m. New York time. This marks the completion of the day's rhythm, setting up for the next cycle. A universal formula for the daily range. If you want to master this flow, here's a simple formula to remember. Consolidation leads to expansion. The quiet phase builds orders before the breakout. Retracement leads to expansion. The pullback creates opportunities for optimal entries. Reversal leads to expansion and then back to consolidation. The market reacts to key levels, reversing part of the move and ending quietly. The beauty of this pattern is that it doesn't just apply to the daily range. It's mirrored across timeframes, from the weekly range to even monthly cycles. For example, the week often starts with consolidation, Sunday, Monday, followed by manipulation, Monday, Tuesday, then expansion midweek, and a reversal or consolidation toward the end, Thursday, Friday. When you understand this formula, you're not just reacting to price, you're anticipating it. You're reading the market like a story, knowing what comes next and positioning yourself ahead of the moves. What is market protraction, Juda Swing? Let's talk about one of the market's most cunning moves, market protraction, also known as the Juda Swing. This is a critical concept for understanding how manipulation plays out in price action and a key element to spotting traps set for retail traders. The Juda Swing is a sharp, deceptive move in the opposite direction of the day's expected trend. It's designed to grab liquidity, essentially targeting stop-loss levels or breakout trades set by retail traders, and happens during specific times of the trading day. For example, you might see this during the London kill zone, which runs from 2 a.m. to 5 a.m. NY time, or just before a major news release. These moves appear convincing at first, enticing traders to chase the price, thinking they're catching a breakout. But here's the twist: the market suddenly reverses direction, leaving those traders stuck on the wrong side of the trade. Think of it as a carefully laid trap. The Juda Swing isn't random, it's a deliberate move by the market to exploit liquidity and set the stage for the true trend of the day. How to spot and use market protraction. Market protraction, or the Juda Swing, isn't just a manipulation, it's also an opportunity. If you know how to identify it, you can turn this seemingly deceptive move into a powerful trading advantage. Here's how to spot and use market protraction effectively in your trading. Look for a clear run on a liquidity pool. The first clue is when the market sweeps key levels, such as the highs or lows of the Asia session. These areas are prime targets for liquidity grabs, as they often hold stop losses or breakout orders from retail traders. Pay attention to the time of day. Timing is critical. Market protraction often occurs during key trading windows, like the London kill zone between 2 a.m. and 5 a.m. NY time or the New York open kill zone around 8 a.m. to 11 a.m. New York time. These times coincide with increased market activity and manipulation, making them perfect setups for Juda swings. Watch for a sharp reversal. After price runs into a premium or discount area PDA, a significant level of interest, it often reverses sharply. This reversal is your signal that the Juda Swing has completed, and the market is ready to move toward its true direction. Align with higher time frame order flow. For the highest probability setups, ensure that the protraction aligns with the larger market narrative. If the higher time frame order flow and a clear target for the day are pointing in the same direction, you've got what ICT calls a loaded deal. These setups are explosive, high probability opportunities. The trick is being patient, waiting for the manipulation to play out, and then executing your trade in the direction of the reversal. By mastering this approach, you won't just avoid the traps set for retail traders, you'll start using those traps to your advantage. Key trading scenarios. In a typical bullish day, here's what happens. During London kill zone, the market forms the low of the day, LOD, and explodes higher, breaking structure, BMS. The New York session gives a second opportunity to enter during a retracement, setting up the optimal trade entry, OTE. Price expands toward its daily target and begins retracing slightly during the London close, 12 p.m. to 2 p.m. NY time. This rhythm provides multiple opportunities to align with the day's trend, whether you're a swing trader or scalper. Final thoughts and live demonstration. Now that we've covered the theory, let's take it to the charts. Up next, I'll walk you through live examples on TradingView, where you'll see how to identify these patterns in real time. Stay tuned, because I'll show you exactly how to use market protraction to your advantage, whether it's for reversals or continuations, and how to time your entries perfectly. Watch all the way to the end for these valuable insights. Thanks for watching, traders. If this video gave you new insights into how the market works, don't forget to hit that like button to support the channel. Subscribe and turn on notifications so you never miss an update. Drop a comment below and let me know which concept you're most excited to apply in your trading. Remember, trading isn't just about luck, it's about understanding the game. So, let's head into the live demonstration and sharpen those skills. See you in the next video. Stay sharp and trade smart.